You know, one of the biggest surprises people run into when they are upsizing isn't actually the price of the next home. It's the timing, because on paper, everything looks fine. You built your equity, you sold your home or you're about to, and you found the next property you want to move into. But then the reality hits. The dates don't line up. You might be closing on your purchase before your current home actually closes. And suddenly the question becomes, how do I come up with the money to close the transaction? Not because you don't have it, but because it's still tied up in your current home. And that gap is what we call bridge financing. Let me walk you through this in a very simple way. When you're upsizing, your equity is sitting in your current property. Until the sale actually closes, you don't physically have access to that cash. So if your purchase closes first, the lender steps in and says, we'll temporarily lend you money you're expecting from your sale so you can complete your purchase, and then your home sells and the funds come in. That loan gets paid off automatically. You are literally bridging the gap between two transactions. Now, there's another scenario where this comes up, and it's actually more strategic. Sometimes buyers intentionally take early possession of the new home, not to move in right away, but to renovate. So they buy the property, they close, they spend a few weeks or months updating it, and they move in once everything is done. During that time, they still own their current home. So again, the money is tied up, and bridge financing allows them to execute that plan properly without rushing the move. Now, here's something very important. This is not something you figure out after you've already bought a home. This needs to be discussed with your mortgage broker before you form up a purchase, because the lender needs to confirm a few things: how much equity you can access, whether your income supports carrying both properties temporarily, and whether the numbers actually work for your situation. If those don't line up, you could end up committing to a purchase that becomes very difficult to close. And that's a situation we always want to avoid. Now, let's talk about what lenders actually require. In most cases, especially with major banks, they will want to see a firm purchase and sale on your current home. That's very important because the lender is relying on those sale proceeds as their exit. They'll also look at your purchase agreement, your equity position, and your overall financial profile. A lot of people think this is unsecured money. It's not. The lender is essentially advancing funds based on the equity in your current home and the fact that you have a confirmed sale closing. In many cases, they already hold the mortgages on your existing property, so they're very comfortable advancing that short-term loan. Now, let's talk about cost, because this is where people get caught off guard. Bridge financing is short-term, but it's not cheap. The interest rate is typically higher than your regular mortgage. You might see something like prime plus a couple of percentage points. There are also small administrative and legal costs involved. To put it into perspective, if you were borrowing say $200,000, you could be paying somewhere around $50 to $60 per day in interest. So if that bridge lasts 30 days, you're roughly looking at $1,500 to $2,000. And if timelines stretch, that number increases. So it's not something to ignore, but it's also not unreasonable when used properly. Now, in terms of repayment, you don't actually have to do anything manually. On the day your sale closes, your lawyer receives the funds from the buyer. From that, your existing mortgage gets paid off, the bridge loan gets paid off, and the remaining proceeds are transferred to you. It's all handled behind the scene. Now, let's talk about the risk, because this is the part you need to respect. Bridge financing works very smoothly as long as everything goes according to the plan. But real estate doesn't always go perfectly. If your buyer delays closing or something unexpected happens, you may need to extend that bridge loan. And extensions cost more, require lender approval, and can create stress if not managed properly. And in some cases, you could temporarily be carrying your new mortgage, your existing mortgage, and even the bridge loan on top of it. So this is where strategy really matters. Not just price, but how the deal is structured and who you are dealing with. And that really brings me to the bigger point. A lot of people think real estate is just about price, which I keep saying saying it's not. It's about timing, structure, and execution. Bridge financing sits right in the middle of all three. So if you're thinking about upsizing, this is a conversation you want to have early. We need to look at your timing, your numbers, whether you buy first or sell first, and how to structure the transaction properly. If you want, reach out to me. I can walk you through your specific situation and connect you also with a strong mortgage broker who understands how to set up this the right way. You can call me or text me anytime, 647-818-7373, or book a time using the link below. I'm Realtor Roshan, and I'd love to see you on my next video.